You're listening to the Generational Wealth Through Commercial Real Estate podcast. Your host, Will Smith, is a former NFL player that found his passion in commercial real estate. Every week, you will learn from industry experts everything you need to know to get started investing in commercial real estate to build generational wealth.
Thank you for tuning in to the Generational Wealth Through Commercial Real Estate show. We've got a very special guest lined up today, but before we get into it, if you're watching this show for the first time, do me a favor and go ahead and hit the subscribe button. I want to keep adding value to my listeners. And, one way I could tell by that is, seeing that my subscriptions are going up. And if you haven't left a review, I need your reviews. These reviews are what keep allowing me to bring on rock star guests like I have today. Okay, housekeeping is out the way. Let's get to today's show. All right, JC Castillo is a seasoned commercial real estate investor with over 10 years experience funding, purchasing, renovating, and operating large-scale multifamily properties. In 2006, he founded Multifamily Property Group, a vertically integrated private equity firm focused on large-scale value-add apartment properties in select high-growth U.S. markets. In 2013, he co-founded MPG Residential to serve as the exclusive in-house management arm for all MPG assets. JC, how we doing today, man?
Man, I'm doing fantastic. Thank you so much for having me on the show. I've actually seen your show on LinkedIn, snippets of it, and listened to your podcast. I actually really love your story.
Yeah, I appreciate it, man. Well, obviously that was a really, really fast rundown of kind of where you're at right now. Like, tell us who you are and how you got to where you're at now.
Well, you know what? My story is a story of just like anybody else is of, perseverance and relentless, drive to sort of get where we've gotten and having an amazing team behind me to do it. So, I got out of school as an engineering major in University of California, Santa Barbara. I worked in the semiconductor business for about 15 plus years here in the Silicon Valley. San Jose, California is where I live.
Yep.
And somewhere along the way, I really fell in love with real estate. I had purchased a couple of single family rentals, way back when in the earlier 2000s.
Yep.
And made a little bit of money from those and decided that I wanted to really scale up, got into multifamily. Right around 2004 or 5, I started doing my research and started buying my own deals in 2006 timeframe. Yep. And really my business was kind of born, not necessarily out of wanting to create a business, but really out of just finding a really good niche where I became really good at the multifamily space. And a lot of my technology buddies, a lot of high net worth guys in the technology space just started coming along for the ride, if you will. And yep. That's kind of how my company, my syndication business was born. So really what we are today is really nothing more than a bridge between the capital that's mostly comes out of the Silicon Valley, and we funnel it into really great high growth markets and what we would call very business friendly markets like Texas. And so we've been doing that since 2006. We've been through the recession. Yeah. As multifamily owners. That's sort of a rarity. So we've got, not only the experience of the good times, but we know what it takes to make it through the bad times. Yeah.
Yeah. No, that's a pretty good story, man. And you're in the perfect area where there's a lot of capital and, buying real estate over there, it just doesn't work, numbers wise. So, it's very smart to be looking at high growth markets where your investors' capital can grow. So, I think that makes a lot of sense.
Yeah, we've been really fortunate to have sort of ridden that wave. It's definitely been more pronounced since the pandemic hit. Right. But these sort of migrational trends were already happening, way back when. I mean, people have been, especially the young educated workforce have been, moving away from the high cost, coastal areas and really looking for a more, affordable lifestyle, be able to get a nice home for less than $1 million to buy a shoebox in the Silicon Valley, which is what you're looking at here. So, we've really benefited from the patterns and the trends that have happened, but certainly we've seen an acceleration of those sorts of things with the pandemic.
Yeah. And I want to talk about that because, a lot of the investors that's out there now, they, seeing that multifamily has been going up like crazy since, 2010. And, a lot of these investors in the marketplace right now, they haven't been through a recession. And I want you to talk about for a moment, if you could, how do you, number one, recognize that, the market is getting ready to change, or we're about to go down in a dip in values, because, it's been going up like crazy since 2010. So, talk about it for a minute.
Well, the reality is that you can never, really truly time a downturn in the perfect sense.
Yeah.
But I can tell you from experience that, back in the 2006-07 timeframe, right before the recession hit, the financial recession, the Great Recession,
Yeah.
it was kind of just like today, where people were just buying assets. Multifamily wasn't quite as popular, but single family homes were super popular. Where people just buying them by the boatloads.
Yeah.
And the prices just kept going up, and people just figured, what, this isn't going to stop. And sure, there was they were in the back of their minds, there was a little bit of hesitation, but people just kept seeing the numbers, and the numbers are very compelling, and it's tough to kind of step back and go, well, what happens if something turns? So, what I learned is that, I've learned to really structure these deals to be very much more long-term focused, and to look for the downside just as much, or if not more, than you're looking for the upside. Because certainly we're at a point in time where there's a peak in the market.
Yeah.
And so what that means is that if there is a sudden turn, if you're exposed in terms of a little bit higher leverage, or if you've got some assets that are not such great quality assets, you're really going to suffer. Or if, for example, you don't have a really great operational plan and strategy, if you've got a really mediocre property management company, during a downturn, operations become a lot more important, because it's not about equity, right? I mean, over the last, like you said, 10 years, it's been pretty easy. If you just bought an asset and you held it, the market forgave you for you being a bad operator or being a great operator. It just really didn't matter. But what I saw in the recession is that operations really were the difference between, really thriving or really having a tough time and possibly going under.
Yeah. Yeah. No, that's a really, really good point. Because at the end of the day, you can have all of the charts and models that you want to have, but if you don't have the right person, behind those charts, running the ship, then, it's all going to go down. So, that's a really, really good point there. Now you said you choose high growth markets, and that's definitely important when you're going into a downturn, because that market is going to bounce back the fastest. So let's talk about for a moment, how do you choose your markets that you want to deploy capital into?
Well, first of all, everybody has a little bit of a different approach to sort of how they go about selecting markets. What we are big believers in is that we are big believers in going long in a market and going very deep in a market. So what do I mean by that? What I mean is that, if you're really trying to build a sustainable business that's really going to be able to uncover these great properties to take down and invest in, and you've got to be willing to really learn a market inside and out. So what we did a long time ago is, and this was back in the 2005-06 timeframe, is I started studying market trends, and I really loved Texas. Texas really spoke to me for a number of reasons: business friendly, a lot of growth happening. Fortune 500 companies back then were really starting to accelerate their movements, and so huge population growth. And so I really knew that Texas would be sort of a place where we could go put up a flag and really just be there for 20, 30, 40 years. And so what we decided to do was really focus on learning the insides and outs of Texas. We became very good in Dallas-Fort Worth. That's really where we've built our home and our base. We have, literally bought thousands of units in Dallas-Fort Worth. We have a portfolio of, I think, around $70 million right now under management.
Nice.
And so because of that, we haven't necessarily scaled out to other markets, but Dallas-Fort Worth, I believe they have around 700,000 market rate units. That is market rate units. And that's the second largest concentration of apartment units in the nation, behind New York, I believe. Yeah. So we've got, just an unlimited number of deals to choose from.
Yeah.
And we have a really deep ecosystem of partners, brokers, vendors, people that we've worked with for, 10 plus years now. And so, for us, we just really have such a deep connection now in the market that we're able to really still find deals, even as the market is at what we would definitely call a little bit of a market high.
Yeah. No, that's important, especially like you say, going deep in the market, setting your roots there in the market. It allow you to do what you're doing now with your vertically integrating your firm there. So let's talk about what you're doing there to increase the efficiencies of, your operations.
Yeah, absolutely. So, look, I really believe that operations. First of all, I have a passion for operations. A lot of apartment owners really, aren't as passionate about operations.
Yeah.
But for me, that's something that I just really enjoy, and that I think that I have a good way of going about it. So really where operations becomes really important, especially if we talk about what's happening right now with a pandemic induced recession, is customer service, I think, becomes super critical. And it's a very underrated quality to have. We're pretty maniacal when it comes to our properties about making sure that our residents, which we call customers, we don't necessarily like to call them residents, we call them customers, because we do have a choice where they live. We're pretty maniacal about making sure that if there's a work order, that we service it quickly and we do it right. We follow up with a phone call, for example, to see if the work order was done right. We're also very maniacal about asking for, which I love, by the way, what you did in your initial opening of your podcast, is you asked for positive reviews. You asked for reviews. You'd be surprised if you don't ask for reviews, you don't get them. We're out there when we're talking to our residents or our customers, and they're really happy about a work order. We ask them, and we send them a link with a text. Here's the link to post a review on Google. Please do that. This is the way that we get rewarded for being, great stewards and great partners to you as a customer. And we challenge people, and you'd be surprised at, if you really focus on the customer service piece, what happens in a recession is that, and what we've seen in this recession is that there's been not so much a drop off in revenue collections. We're still being able to collect revenue, thank goodness. But the occupancies have started to dip, even for the B class properties and some of the C class properties. So what that creates is an opportunity for the customer or the resident to have choices, because they got more places they can go.
Right.
And so, of course, if you're a customer, you're going to look for your best value for your dollar spent. And so if I'm a property owner that's got an amazing customer service piece, and I've got great reviews, believe me, when the residents are looking online, they're going to find my property and go, you know what, all things being equal, I'd rather spend my money at this place, because they're going to give me a great product and a great service. And so that's where I think the operations piece becomes so important. So, I want people to understand is I didn't first start talking about profitability. Because I believe that if you take care of your customers and you treat them right, I think the profits always follow. Now, that doesn't mean that we aren't focused on profitability, because that's a key element of what we do as an operations team. However, I'm a big believer that, it's not just about making, it's not just about how much profit we can make. That's true, but it's about how much margin we can charge, because we just have a better product. And if we charge enough margin, that means that's going to give us some headroom to spend a little bit of money on our properties to make it better. Because at the end of the day, the resident's probably willing to pay a couple more bucks for a great service.
No, that's very true. I'm a big guy. I'm 340 pounds, 6'6". So I like to eat. And just a food example, you can go to an Outback Steakhouse and you can get you a decent steak and you'd be happy with it. But if you go to Roof Chris, their steaks, taste 10 times better. The service is 10 times better. And yes, you're going to pay more, but I'm happy to pay that extra to get that extra quality and service and in food. So, what you're saying is very true.
And I think that people, it's a great point about food. And I think that people mistakenly, they don't equate the apartment experience the same way they equate other things. Like, in other words, you really have to make yourself think like a customer and like a resident, and understand that great customer service, and great product quality, if you can really achieve that, and believe me, nobody's perfect. We make mistakes too on the operations side, but we're going to apologize for it and we're going to make it right like immediately.
Right.
But if you can get that combination right, it just makes the experience so much better for the customer, and they're willing to pay you a premium for that. And that premium really is the difference between being able to keep getting quality residents. Because let's take this a step further.
Yep.
People that are willing to pay a few more extra dollars to stay at a place where we're going to fix your work order with a smile and do it quickly, guess what? Those are the people you want at your property. The ones that just care about the cheapest cost of living, believe me, if that's all you have at your property, you're really going to suffer, because you're going to have a lot more delinquency. You're going to have probably a lot more people doing not so great stuff to your property.
Yep.
So the way that you keep your tenant base amazingly great is by treating them right, and the community word gets out, and the good people, they just flock to your place. And believe me, we've seen it happen so many times.
Yeah. No, that's a very good point. Now, when you're taking over a new asset, obviously you guys are vertically integrated, so you're doing management yourself. Do you get rid of all of the current staff that's there, or do you try to work with them and train them up on your policies and procedures?
Well, the first thing that we'll normally do when we're in the contract to take over property is we will start having a conversation with the current seller about the staff, and we'll just ask them, what, are you guys going to keep your staff, or are you going to let your staff go? Yeah. One of the big things that I think people don't really think about is actually the more important people that we want to keep are the maintenance people.
Yeah.
The maintenance people are really they unlock the secrets to what you need to fix at the property, because they're in the units every day fixing stuff. They know what doesn't work. They know where we need to spend our capital dollars. And also they actually have a pretty good connection with a lot of the residents that are there. And so now that's if they're great maintenance guys, which maintenance guys, I've seen most guys are amazing. They work really hard and they get their stuff done. Yeah. So we're going to start talking with the seller during the sales process, and we're going to ask them, hey, look, are you going to keep your staff? Are you going to move them out? If they say, no, we're not going to keep them, you can talk to them. Then we're going to have those discussions, and we're going to really try to determine which guys want to stay with us and which gals want to stay with us. Yep. And try to get at least one of the maintenance people to stay with us through the transition, because that's really going to be the key. If we've got a great community director as well, certainly we would be okay with keeping them. But in my experience, what we found is that that's not as important to keep as it is to keep a couple of the key maintenance people. So through the transition, staff is really important to us, but I think it's also who you keep and the way that you go about using the knowledge that they have to execute your plan when you take over. Yeah.
No, that's some good nuggets there, man, for sure. I know a lot of people writing that stuff down for sure. Okay, so obviously you've been in the market for some time now, so you're probably getting more deals than you can even look at. But if you can remember back when you was just getting into the market, how did you go about finding your deals?
It's a great question. I think that a lot of times people forget about the number one criteria for finding deals, and that is relationships. Yep. Multifamily is not a business where you're sending out a lot of letters. It's real. I mean, you can do it, sure, but your chances of making that work are very slim, because most of the people that are really looking to sell these large scale properties are not really the type of people that are going to be interested in reading a letter about, you put a couple aspirin in an envelope and you tell them that you want to solve their headache by buying a $20 million property, right? Or a $10 million property. The relationships you want to focus on are your brokers that are very connected to deals in that market, because the brokers are going to, in any market, let's say for Dallas Fort Worth, for example, there's probably 7 to 8 brokerage shops that do 80% of the business. Yep. Right. So you got to know those 1, 2, 3, 4, 5, 6, 7 brokerage shops, and you got to start developing relationships with those brokers, because those are the people they're going to bring you your first deal. Yep. And another really big tip I would give you is that if you're just getting started in the business and you're looking to buy a property, don't go and call the biggest name at the brokerage shop and think that you're going to get a deal with them because they've already got their, what I call their Fab Five.
Yep.
Those are the first 5 people that they call when there's a deal that comes up that's a great deal. You're not going to be on that list if you're getting started. So what you really want to do is focus on, call it like a younger person or a more new person that's coming up on that brokerage shop's team. Yep. That's really hungry and motivated to make their name.
Right.
And if you can find that right person, you guys are going to be at that same level, and they're going to go out and they're going to go bird dog, and they're going to work their butts off to bring you a deal.
Yep.
And you're going to rise together.
Right.
That's, I think, the way that when I first got started, that's what I did. I happened to really build a great relationship with one very key broker, young person that was very motivated, that ended up becoming very big.
Yeah.
And today they're a very big mover and shaker in DFW. But we pretty much did each other's first deal together.
Wow.
And so that relationship has, through the years, really grown. We've become very good friends. And so, now I'm on that Fab Five, and I guarantee you, if you're just getting started, it'd be pretty hard to do business with this guy, over a guy like me. But that doesn't mean that there's not 15 other guys that are super hungry that are going to be there in 10 more years. You just got to get on that train.
Yeah. Yeah. No, that's really, really good advice. I'm a broker here in North Carolina, and I'm 1 year in, so I'm the guy that everybody's reaching out to, trying to do exactly what you're saying, build a relationship so we can grow together over time. So what you said makes a lot of sense.
Yep.
All right. So so the deal comes in, and now you're like, shucks, I got a deal. Like, does it work? Can I buy this? Can I take it down? So let's talk about underwriting for a second. What do you look for to see if a deal really makes sense for your group?
Yeah, look, everybody's got their own sauce on underwriting.
Yep.
I think the key is that you got to keep it simple, and you really got to go back to the basics. Okay. So, number one, when you're underwriting a deal, the first thing that you want to do is you really want to focus on the T12. Okay. Forget about the pro forma. Forget about what the brokers are telling you that the deal is going to do. You want to look at the actual performance of the last 12 months.
Yep.
Okay. Look at the income patterns, look at how much they're collecting, look at how much delinquency they have. One thing that I like to do, if you can do it, is I like to actually ask for, and if the seller's willing to do it, it's amazing, a T12 list of running delinquency. All right. Yeah. So, like, in other words, I know from personal experience that if we have a property that consistently has a high delinquency balance, let's say on the 10th of the month each month,
yep,
I know that property is going to be a lot harder to operate, just because you got a lot more people that don't pay on time, right? That means you got more of you're going to have to turn that tenant base or somehow figure out how to get them to pay a little bit more on time. Now, alternatively, when I have a property that has very little delinquency by the 10th of the month, I know that's going to be a winner.
Yeah.
So you really got to be a detective when it comes to that type of stuff.
Yep.
But not to the extent where you upset the broker, but to the extent where you're serious about a deal and you're really doing your due diligence. Become a detective. So look at the T12. When I'm underwriting my first year, I don't really like to expect a whole lot of increases beyond what the current owner is doing.
Yeah.
Right. In other words, if the T12 is generating $1 million of net operating income,
mm-hmm,
and you get into your year one pro forma, if you're thinking that you're going to suddenly generate $1,100,000, a 10% increase in 12 months,
yeah,
I really think that even in the good times, I think that what you're expecting yourself to do is a little bit too high of a bar. Instead, I really like to think that year one is really about resetting the bar at the property. So it means really coming in and giving to the residents. So you're putting all this money into the property, you're renovating the exterior, you're upgrading the units, you're increasing the customer service, you're doing all these things. So you got to pay your dues to the residents, the customers.
Yeah.
And then after 9 months or 12 months, we see it happen all the time. Things just start to take off. So I really like to focus on being a very conservative year one guy.
Yeah.
And really bank on the fact that in year two is when we're going to start to see that acceleration of revenues if we've been doing everything right.
Right.
And expenses usually are what they are. I mean, expenses don't necessarily change. In fact, I would say expenses are sort of these days are like the hidden killer.
Yeah.
Things like insurance and property taxes just have been going up like crazy lately. And I don't see that stopping based on a lot of the pandemic related issues that are coming up with, municipalities being short on revenue. So it just means you got to be more operationally greater than ever to really turn a profit in this new decade that we're in.
Yeah. Yeah. No, that's it's all really, really good points. Is there anything on the other income tab that you try to put in a deal to make it make sense, or maybe there's something that's there in their other income that shouldn't be reflected in the other income? Can you talk about that for a second?
Well, look, I think that technology is great because technology enables us to do so much with other income. We can charge for, we can charge for dogs, we can charge for parking.
Yeah.
We can charge for, you got 2 beds in your room. I'm going to put a 2-bed adder because you got 2 beds in your room. So, I think that there's a lot of sophisticated people in technology that can charge for a lot of different things. We are big believers in charging for sort of what are the normal things.
Yeah.
Trash, pest, parking, pets, et cetera. But we really don't like to have a exorbitantly laundry list of adders because we'd rather just increase the rent.
Yeah.
Right. We like to keep it simple. We know from talking to our customers that, they don't mind paying for things that are standard for the course in the local market. But when you start charging, for 10 million different things and ways to make income, I think at some point there's a loss of the value in that. And you start to actually trade off a really upset customer for a couple more cents. And why not instead just increase the rent that you're charging? And then the customer's like, well, this is a simple deal. I pay $20 more in rent than the competitors, but I got a great product and I've got a normal set of adders that I charge for. So you might be surprised to hear that when we underwrite deals, we normally don't tack on a whole bunch of different adders. What we're really going to do instead is look to really simplify to what the standard market pricing is for the adders.
Yep.
And then if we have to adjust that rent, we're going to do that.
Gotcha. No, that makes sense. All right, man, let's go ahead and segue to the next segment of the show. We're going to do a deal deep dive. So let's talk about a deal that you've done in the last 5 years. How many units was it? What was the value add, kind of debt, exit strategy?
Okay. Well, we did a deal called Arroyo Apartments in Dallas. We picked that deal up. I'll talk about that deal since we're a little bit further on in the reposition cycle.
Yep.
We picked that deal up it's built in 1983. And it was owned by an owner for about 20 years or so. And it was an off-market deal that we had a great relationship with a broker in Dallas that we picked up.
Yep.
And so the deal just had great bones. We drove the deal and we immediately saw that it was a fantastic opportunity, which they're a lot harder to find these days. So we picked up the deal for, I believe, about $16.9 million for 192 units. And we put about $1.6 million of capital into the deal to reposition it. Mm-hmm. We put probably about $1 million into the exterior and amenities.
Yep.
And we've got about 600,000 or so that we are using to upgrade units as they become vacant.
Right.
And so, I think we're probably all in for, right around $100,000 a unit.
Yeah.
At that deal. And really that deal we've had it just about under 2 years now. Mm-hmm. And that deal has really taken off and is doing quite well. And really it's nothing more than, again, focusing back on the fundamentals of first, we really gave to the property and to the community. We really built and renovated and repositioned an amazing property, amazing product for the customer.
Yeah.
And that took us, 6 months to do. And then as we started turning units and really focusing on customer service, giving, a great move-in experience when people move in,
right,
giving great work orders experience when people have a problem, we really started to see the Google reviews start to come around. And I think when we started, the property had Google reviews. I think it had maybe 20 reviews total.
Yeah.
and it probably had like a 2.4 to 2.6 star Google review rating.
Right.
If you look at that same property now, that property's got, I think it's a 4.4 star review rating, and there's nearly 100 reviews.
Nice.
So believe me when I tell you that it's not just about, the dollars and cents. If you really want to make your property make money, you got to focus on the customer piece, because now what happens is we get so much traffic coming to the property from just Google reviews.
Right.
And they come in and they already know from reading our reviews that we got a great product and great service. So they're almost sold themselves before they even step foot into the door. And of course, once they see the property and they walk in and they get the red carpet treatment from there, they want to live at our property. It's just, that's just what it is. Right. But it's the work that you put in to get to that point is when you see the payoff happen, it comes later. It doesn't come at first.
Yeah. Yeah. No, that's awesome, man. So you've got it figured out for sure. I could tell by the reviews, and then giving them the red carpet experience. Man, that's great salesmanship all the way around. You get it. These are customers, and we want them to pay us instead of paying the community next door. So that makes
and
a
you
lot
got
of
it.
sense.
And because we've had such a great 10-year run, I think that a lot of apartment owners have become a little bit lazy when it comes to, the customer experience, because their properties were full no matter what. And they were just in it to flip the deals every 2-3 years.
Yeah.
And it was what it was. If people got, upset, you had residents that were not happy, you had bad reviews, you were still 95% occupied.
Wow.
And rents were still going up, 4 or 5% a year.
Yeah.
It's not like that anymore. So, the customer has a lot more power in the relationship now. And because of that, the people that are really going to double down on customer experience are going to be the ones that are going to really thrive and prosper in this next decade. I am completely convinced of that.
Yeah. 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 I mean, that makes sense for sure. Now, what's the exit strategy for this deal?
We're long-term holders for the most part. So this deal, when we bought it, it was a 12-year hold.
Mm-hmm.
And that's just because we just really like the location of the asset. We really like the fundamentals of the deal and how much upside there was. So for us, it's a 12-year exit. We sort of work with longer-term capital here in the Silicon Valley. We're not really as big on turning deals every 2 to 3 years.
Right.
Don't get me wrong. We sell deals in 2, 3, 4, 5 years. But there has to be a big boatload of money on our doorstep that we just can't pass up, or a strategic reason why we want to exit the deal. But what we've seen is that when you go 10, 12 years, you sort of get to, ride out any sort of speed bumps in the meantime.
Yeah.
And you can come right back, and those values are going to hold up and get even a little bit better in those longer hold periods. So what we're really doing is we're reducing our risk by not having strategies that bank on flipping deals every 2 to 3 years.
Yeah.
And that's the way, that our investor base wants to operate. Now, you can certainly take more risk, and you can have a different investor profile that wants to be in and out and really focus more on equity.
Right.
And so I think that's the beautiful thing about each company is we all have, the investor base that we cater to, that we serve. And ours just is a little bit less willing to take risk and a little bit more slow and steady with cash flow focus.
Right. No, it makes sense. Like you said, every strategy is different. A younger generation, they're probably going to want to have their money cycling in. As you get the older investor, hey man, I just want to preserve my wealth. Give me a solid return. I'd be happy, So
you hit the nail on the head. Is preservation of capital is really a top concern for the investor base that we work with.
Yeah.
And by the way, I'm one of the largest investors in our deal. So, I can tell you from my experience that preservation of capital is at the top of my mind when I'm looking at deals. It's not necessarily maximum cash flow or maximum return.
Yeah.
It's really a combination of risk mitigated returns is what I'm looking to optimize.
Yeah. Absolutely. For sure, man. All right, let's go ahead and segue to the last segment of the show. It's our lightning round. Got 6 quick questions for you.
All right.
Number 1, what's the best advice you ever been given?
Best advice I ever been given? Slow and steady wins the race, man.
100%. Number 2, what's the best book you've read this year?
This year, Free to Focus by Michael Hyatt.
Nice. Want to check it out. What are some rituals that you've created that's making you a better investor or person in general?
Gratitude to my partners, gratitude to our investors, and gratitude to the employees and the people that work at our properties.
Yep.
I think gratitude for me has really changed the way that I present myself and interact with my partners.
Yeah. Awesome. Number 4, what is one thing you're doing right now to help you improve your business?
The one thing that I'm doing, I think, is really a much bigger focus on meditation and making sure that that there's some quiet peace every day to really train myself to do a better job of looking at all the different angles of what these decisions are and what they need to be done. So for me, actually, meditation is one of the things I think that is starting to become a bigger and bigger piece of my business arsenal, and it's something that's kind of unexpected even for me. I mean, I didn't think that it would help, but it certainly has.
Awesome. All right. If you can give your younger self one tip in regards to investing, what would that be?
You know, I think that the biggest piece of advice I would give to my younger self is focus on 2 things, okay? Focus on building businesses that create, a stream of residual income, and focus on becoming an expert in the way that tax laws can help you as an investor.
Awesome. Great advice. And then the last question is, what's the worst job you ever had?
You know what, man? I every job I've had, I've actually really loved. So I'll have to tell you that there's not been a single thing that I haven't loved. I mean, I usually just go full in with whatever I'm doing.
Awesome. Good deal, man. Well, hey, that's the end of the show. Tell my listeners, how can they get in touch with you, JC?
Well, yeah, if you want to get in touch with me, you can go to my podcast. We have a podcast called Apartment Investor Show. You can go to apartmentinvestorshow.com. And you can check us out. We do, a lot of expert advice with people that know what they're talking about in apartment investing. So if you're ever interested in learning about the odds and ends of how things work in apartment world, that's something you should definitely check out.
Awesome. Appreciate you coming on the show today, man.
Thanks a lot for having me, man. It was fun.
Absolutely.
Thank you for listening to the Generational Wealth Through Commercial Real Estate podcast, brought to you by Onyx Capital Investments. Onyx Capital Investments works with investors nationwide to invest in income-producing real estate in emerging markets. Connect online at www.onyxcapitalinvestments.com to learn more about what we're doing. If we have added value to your life, please leave us a review.